In Loudoun County, Virginia, a landowner sold 97 acres for $615 million, more than $6 million an acre, over 10 times what that same parcel sold for just 4 years earlier. Nobody built a house on it. They built a data center. That's the real AI boom happening right now, and it has almost nothing to do with chips. Quick note, this is education, not financial advice. Full disclaimer in the description. Every headline about artificial intelligence shows you a chatbot window or a humanoid robot. The actual infrastructure behind it looks like a windowless warehouse next to a substation, sitting on hundreds of acres that used to be farmland. This episode is about that infrastructure, the land, the power lines, the queue to connect to the grid, because that's where the real money and the real cost to ordinary people shows up. Start with the basic physics nobody puts on a billboard. A large language model doesn't run on hope. It runs on racks of specialized chips packed into buildings, cooled constantly, and drawing electricity around the clock. 2 years ago, the bottleneck for building more AI capacity was chips. Today, according to the companies building these facilities themselves, the bottleneck is land next to enough electricity to run it. And that combination is far scarcer than most people assume. The International Energy Agency puts real numbers on this. In its Energy and AI report, the IEA estimated global data center electricity use at around 415 terawatt-hours in 2024. In its base case, that climbs to roughly 945 terawatt-hours by 2030, more than double, and toward 1,200 terawatt-hours by 2035. The IEA also found data center electricity demand growing at around 15% a year through 2030, more than 4 times faster than electricity demand from every other sector combined. Break that down by region, and the United States carries the largest share. The IEA projects American data centers alone will draw around 260 terawatt-hours in 2026, with Europe adding roughly 150 terawatt-hours of its own. The U.S. already accounts for the single biggest slice of global data center electricity use, and that share keeps growing. So who decides whether all these new power-hungry buildings actually get connected to the grid? That's the second number almost nobody outside the utility industry has heard of: the interconnection queue. Every new power plant, battery system, or large customer wanting a serious grid connection has to get in line and wait for a study proving the grid can handle it. Lawrence Berkeley National Laboratory tracks this queue every year. In its most recent count, roughly 2,061 gigawatts of generation and storage capacity, spread across roughly 8,200 separate projects, is sitting in that queue nationwide, waiting for permission to connect. Some projects wait years just to get an answer. That queue matters because data centers don't only compete with each other for chips. They compete with every solar farm, battery project, and gas plant in the country for a limited number of grid connection slots and nearby transmission capacity. A developer who can secure land already next to substantial power infrastructure has a massive head start. Exactly why this land grab is happening where the power already is, not where land is simply cheapest. And the money chasing that head start is enormous. The 4 biggest hyperscalers, Microsoft, Google, Amazon, and Meta, spent a record amount building AI infrastructure in 2025, roughly $388 billion combined. Guidance for 2026 points meaningfully higher. Amazon toward roughly $200 billion, Google toward around $180 billion, Meta toward the $120 billion range, Microsoft toward roughly $115 billion. Industry-wide hyperscaler spending is now widely projected to top $600 billion in 2026 alone. Go back to that Virginia land sale. Loudoun County is home to what the industry calls Data Center Alley, the single densest concentration of data centers on Earth, carrying a huge share of the world's internet traffic through it. Land values in the immediate area have reportedly passed $1.2 million an acre in recent deals, and county-wide land prices are up sharply over just the last couple of years. Longtime landowners, farmers, families who'd held property for generations are becoming millionaires by selling to developers who need exactly one thing: acreage next to transmission lines. So who actually profits from this land grab? Three groups mainly. First, landowners who sell or lease acreage to developers, a windfall for whoever happens to own dirt next to a substation. Second, real estate investment trusts that own and operate data centers as their core business, like Digital Realty and Equinix, which lease capacity to the hyperscalers and collect rent for decades. Third, the utilities themselves, which get to expand their regulated asset base. The wires, substations, and power plants they are allowed to earn a guaranteed return on, specifically to serve these new mega customers. Look at what those data center landlords are doing with the boom. Digital Realty has told investors it plans to spend $4 to $5 billion a year on new capacity through 2029, aiming to roughly double its footprint, adding as much capacity in 5 years as it built in the previous 27. Equinix, the other major player, reported bookings jumping more than 40% year over year in its most recent quarter, and now runs more than 500,000 direct interconnections worldwide. This isn't a speculative side bet for these companies. It is the entire business. Utilities are the quieter winner, and the mechanism isn't intuitive. Regulated utilities don't make more money by selling more electricity directly. They make more money by building more infrastructure, because regulators let them earn a fixed rate of return on whatever they spend constructing it. A wave of new data center customers gives utilities a once-in-a-generation reason to build new power plants and lines, all of which grow the asset base their profit is calculated on. That's a legitimate opportunity. It's also why some of the cost of connecting one mega customer ends up spread across everyone else's bill. Which brings us to what this actually means for your electricity bill, because that's the part with real hype attached to it in both directions. Start with the honest, verified number. PJM, the grid operator covering 13 states from Illinois to Virginia, runs a capacity auction that sets what utilities pay to guarantee enough power plants exist for future years. That price sat under $30 per megawatt day for the year ending mid-2025. The next auction cleared at just under $270, roughly 9 times higher, and the one after that hit the regulatory price cap above $329, a record in PJM's history. PJM's own independent market monitor, the watchdog whose entire job is calling out exactly this kind of thing, concluded that data center demand alone was responsible for a majority of that spike, adding an estimated $9.3 billion in costs recovered from ratepayers across the region. That's not a data center company's marketing claim. That's the grid operator's internal auditor. Now here's where we call out the hype. A viral claim circulated in 2026 that data centers had driven electricity prices up 267% in 5 years. Real number, but it measures wholesale prices at grid nodes next to data centers, not a household bill, which is typically only 30 to 50% wholesale. Fact-checkers who dug into the data found the real national picture is a residential increase of around 42% over 5 years, serious, but nowhere near 267. In the hardest-hit spots, it's genuinely steep, up around 94% near Washington, D.C., and 74% in Maryland. That gap between the wholesale spike and the household bill is exactly the kind of nuance that gets lost, and it matters because people are noticing regardless. A survey of more than 2,000 U.S. adults in late 2025 found 78% were somewhat or very concerned that new data centers would push their own energy bills up. In Virginia specifically, where the build-out is most visible, a following survey found nearly 3/4 of voters blaming the facilities clustered in Data Center Alley for their rising costs. And the growth curve isn't leveling off. One industry forecast published in early 2026 projected U.S. data center energy demand nearly doubling again between 2025 and 2028, from around 80 gigawatts to roughly 150, adding something like the electricity appetite of a mid-sized European country in 3 years. For a town that lands a major data center campus, the honest picture is genuinely mixed, not a simple villain story. Host counties can collect meaningful new property and business tax revenue, real money for schools and roads. But that same county's residents may also share in higher grid costs spread across the wider region. Whether or not their town saw the tax windfall, which side of that ledger a household sits on depends heavily on local utility rate design. A boring phrase for something that is quietly deciding who pays for the AI boom. None of this is a reason to panic about tomorrow's power bill, and it isn't a stock tip either way. It's a reason to actually read your utilities rate filings when a large new customer shows up in your service territory, because that regulatory process, not a press release, is where these costs get allocated. State utility commissions hold public comment periods for exactly this. Most people don't know they exist. Step back and the pattern is clear without the jargon. AI's real constraint isn't imagination or chips anymore. It's physical. Acres of land next to gigawatts of deliverable power. Whoever controls that combination controls this build-out's next phase. And 3 groups profit directly. The landowners who own the right dirt, the rate that build and lease the buildings, and the utilities expanding regulated infrastructure to serve it. Everyone else is a ratepayer watching the queue. So next time you see a headline about a new AI data center coming to a town near you, look past the chip announcement and ask 3 questions instead. How much power does it need? Who's paying to connect it to the grid? And whose electric bill moves because of it? That's the invisible land grab. And now you know what to actually watch for. If you want more of the systems quietly running the economy explained honestly, subscribe to CuriosityVerse.